Let me now bring on board Mr. Keki Mistry, Vice Chairman and Chief Executive Officer of HDFC Limited, which is India's biggest mortgage company. Keki, good morning. Thank you for joining us. Keki, let me first start with the moot point. The government of India has unleashed a slew of fiscal measures. Do you believe these steps will improve the fiscal situation significantly?
Undoubtedly. I think reforms were very necessary. The government's trying to make up a little bit for lost time, and we would welcome it and welcome it wholeheartedly. The kind of situation in which we were in India till these reforms started, we were possibly on the verge of a downgrade. There was a risk of a downgrade, and I think with the reforms having taken place, with hopefully the fiscal deficit now getting a little better, with diesel prices being higher, I think the threat of a downgrade has clearly been averted. But the most important outcome of the reforms is the fact that we've seen the rupee appreciate. You'd see that the rupee is now sub 53. And to my mind, I've always said this, the appreciation of the rupee is the most important confidence builder as far as an investor is concerned.
Right, Keki, are you hopeful of the insurance bill also being passed in this current wave of financial reforms? And if that were to happen, would that encourage you to look at an IPO for the life insurance company?
We would certainly look at an IPO when the foreign ownership limits change. But would foreign ownership limits change at this point of time? I frankly don't know. I think it will be easier for the government to pass it through cabinet. But my understanding is that the insurance bill needs to run through parliament. So whether they would be able to take the bill through parliament and get it passed with this kind of controversy, I'm not very sure. So I'm not sure whether insurance will happen or not. But yes, if the bill was to pass, if the foreign ownership limits were to open, we would certainly look at increasing the foreign stakes.
Keki, at a time when most of the global central bankers are following a rather loose monetary policy, do you think inflation will be a challenge for a market like India, which is dependent on import of commodities?
See, I think the biggest risk to India as far as inflation is concerned, to my mind, is oil. So as long as oil prices don't go through the roof, and there are lots of research which would sort of indicate that in the long term oil will head downwards and not upwards. But in the event that oil heads upwards, yes, there is a risk to inflation. The increase in diesel prices will have an immediate increase or immediate impact on inflation. But to my mind, it was very, very necessary, because whilst in the short term inflation may go up, in the long term, had we not taken the measure of increasing diesel prices, inflation pressure would have been significantly higher, because the fiscal deficit would have been higher, government's borrowing program would have been higher, and that would have put pressure on inflation.
Right. Keki, the RBI has signaled with its CRR card that it's ready to support growth further. Do you expect further easing on interest rates in the system?
I think, if you ask me, the cut in the CRR was far more important than a cut in interest rates. Because when you cut the CRR, you straight away leave so much money in the hands of banks, which then gives them a much better ability to sort of lend that money out. They start earning income on the money which was earlier lying with RBI, and that then enables them to cut interest rates. So the impact of, if you want interest rates in the system to come down faster, CRR is a much better way. A cut in CRR is a much better way of achieving that than a cut in interest rates. Having said that, RBI's stated policy all along has been that as long as the government, or once the government starts bringing in reforms, once the government takes constructive measures to curtail the deficit, RBI on its part will also act and spur growth by cutting rates. So I do believe that RBI will start cutting rates. It's very difficult to put a number to it, whether they'll do it next month or they'll do it in the next credit policy. But if you ask me, by the end of the financial year, will interest rates be lower? Certainly they will be lower. How much lower? Tough to say. The way things are looking now, probably 75 to 100 basis points lower than what they are now. But that is by the end of the financial year.
Keki, what about HDFC? At a time when State Bank of India has cut rates aggressively, is HDFC also considering or is considering a rate cut?
See, everyone's interest rates outlook is a function of the cost of funds. So if cost of funds reduces, of course interest rates will come down. We constantly keep watching interest rates, and as and when we see a cut or as and when we see a drop in interest rates, enough cost of funding, we definitely pass that back by reducing rates. We are looking at rates right now. We have seen a reduction in funding costs, and certainly at an appropriate time we will look at dropping rates.
So how is credit demand shaping up for HDFC? I mean, what kind of targets are you looking for in the current year?
See, we have historically looked at a target of a growth of 18 to 20% in our loan book. That has been a historical target for the last 3-4 years. Having said that, the actual growth that we have registered in every one of the last 3 years has been significantly higher. If you take, for example, the first quarter of the financial year for which the results are public, which is April to June, we saw very strong growth. We saw extraordinarily strong growth. Our individual loan book, when you add back the loans we had sold in the preceding 12 months, went up by as much as 29%, which is significantly higher than the growth of 18 to 20%, which we were targeting. So therefore, growth has been strong. I don't want to talk too much of financial numbers in this current quarter, but even in the current quarter, the growth continues to remain robust.
Keki, give us a sense of your spreads and what kind of pressure do you foresee in maintaining your margins going forward?
We have always told the investors over the last at least 10 years that our spreads should be in the range of 2.15 to 2.35. The exact level of spreads on 30th of June stood at 2.27%, and we continue to believe that spreads will remain in the range of 2.15 to 2.35. If you break down that 2.27 between individuals and non-individuals, individual spreads in the first quarter of the year stood at 1.9%, and non-individual spreads would range between 2.7 and 2.9%. So individual spreads are marginally lower than non-individual spreads, but individual loans carry a lower risk weight, number one. Number two, they carry a lower standard asset provisioning. Number three, we provide lesser capital on individual loans. And therefore, if you were to compute on an ROE basis, the ROE on individual loans versus non-individual loans would be more or less the same.
Right. So which geographies will contribute most to your growth in the rest of the year? And are you seeing any signs of real estate prices easing?
Geographies, if you look at Bombay, which used to be one of our largest growth centers, or by one of the largest growth center 10 years ago, has slipped from number 1 to number 3. So if you were to look at the pecking order, today it is Delhi NCR, which is number 1. Chennai is number 2. Mumbai is number 3. Pune is number 4. Bangalore is number 5. Hyderabad is number 6. So that is the pecking order. Now, will property prices come down? In pockets, yes, prices can come down. But I've always maintained, and I've said this on your channel also, that I don't expect any big decrease in property prices. At the end of the day, property prices have to be a function of demand and supply. In a city like Mumbai, demand is always going to remain strong. So therefore, the only way prices can really come down in a substantive manner is if the supply was to increase, and supply was to really dramatically increase. And to enable supply to increase, infrastructure has to improve. So you need to have better transport, where you can connect the northern part of the city with the southern part, probably across the sea with several inlets into the city. You improve the water availability, sewage, medical facilities, hospitals, schools, colleges, education centers, and so on and so forth. And then you can permit buildings to go higher. The problem with Mumbai is that there is lack of land. There's not enough land where you can build. And therefore, the growth in Mumbai all keeps happening as you keep going more and more north into the city. Right
now, do you have any fundraising plans, Mr. Mistry, for next 12 to 18 months, or your balance sheet is adequately funded?
Fundraising, as if you're meaning equity capital, absolutely no. We don't need capital. We have a strong Tier 1 capital. Our Tier 1 capital as of 30th of June stood at 11.8% against a regulatory requirement of 6%. In addition, after 30th June, we had the warrants, for which we received another 30-odd billion rupees, which would add again significantly to Tier 1 capital. So we don't need any equity capital for sure. As far as debt is concerned, we keep raising money on an ongoing basis. We keep fluctuating our funding sources from various avenues depending upon what is giving us access to the cheapest form of funding at that point of time.
Right. So will you be also looking at monetizing any of your listed or unlisted investments this year, Keki?
See, listed investments is a treasury operation. So as and when we see opportunities, we do look at selling and buying and selling occasionally. We don't actively trade in investments, but occasionally when the opportunities are good, we do look at selling when prices are good, or buying when prices are low. But it's very, very small in terms of operations. In terms of our unlisted subsidiaries, our core companies, the companies where we have the HDFC name, absolutely no plans to sell life insurance, asset management, general insurance, venture capital, or of course the bank. So that no plans on that. Unlisted treasury investments, depending on the opportunities, we are happy to look at selling.